Hi, this is Matt Carbray, Matt on Money. We are wrapping up 2019. What a year it's been, and a fast year for a lot of us. So what I hope to get out of this video podcast today is to talk about some of the changes, some of the themes, but also to give you some real life examples, things that we have dealt with as a firm, client situations that I think you may be able to take that information back to your own financial planning and to determine the relevancy or not. So we're going to talk about, to start, the 2018 tax legislation that is still in effect for the most part for 2019 and for 2020, as far as we can tell. What we've also experienced, if we look back in history as our guide, is that most tax legislation, when it's imposed, will not necessarily go back and change the work that you may have done. So we expect 2020 to be a similar year as 2018 and 2019. And the majority of the tax legislation that was passed at the federal level kind of streamlined the tax brackets and resulted in some of the higher base tax brackets, the 39.6 federal bracket going down to 37%. It also looked at the standard deduction limits and increased those substantially so that more tax filers are taking the standard deduction rather than itemizing it. It had an effect on our ability to give to charity and whether we're getting as much of a tax impact as we once did. Some of the 401k contribution limits that were most recently announced are going to have effect on 2020, so not as much 2019. Our health savings account limits, the IRA contribution limits. So all of that to come on this episode of Matt on Money. All right, so now let's talk about some of those contribution limits for the 2020 tax year as we start to plan for some of the decisions that we're going to make as individuals and as employees. Most notably, the 401k contribution limit was previously $19,000 per year for those of you that are under the age of 50. That new limit is $19,500 for those of you that are going to turn 50 or are over the age of 50 in the 2020 tax year. That limit is $19,500 plus a catch-up contribution of $6,500 for a combined contribution of $26,000. What's important to remember is any contributions that your employer makes on your behalf, or if you're self-employed and you have a match or you have an employee or employees, that does not count against your limit. So if you're trying to maximize every year, make sure that your payroll is coordinated so that between January 1st and December 31st, you can get to those higher contribution limits. For those of you that are in a high deductible health plan, and just because you have a high deductible on your health plan doesn't necessarily mean that you have a high deductible health compatible plan. The reason that that's important is if you do have an HDHP, a high deductible health plan, you can have a health savings account along with it. Those contribution limits have slightly gone up as well. So $3,500 to $3,550, $7,000 to $7,100 if you are a family. If your employer does make any contribution on your behalf, you have to reduce what it is that you put in there. I will continue to pound the pavement about the health savings account being one of the most preferential vehicles in all of the tax code, in that it's tax deductible on the money you put in. You do not pay any tax on the growth within the account. And then lastly, when the monies are distributed, when used for qualified reasons, there's no tax either. Now, you heard me mention briefly, there's no tax on the earnings. A lot of you may just be using a savings account or a bank account for your HSA dollars, but I would inquire about whether your plan has an investment arm where you could transfer your HSA balance to something where you can invest those dollars. That only makes the benefit of an HSA that much more powerful. How about IRAs, individual retirement accounts? The contribution limits under the age of 50, $6,000. Over the age of 50, $7,000. And that is whether you use a traditional or a Roth IRA. So not much of an increase there and not much of an increase with the HSA and the 401k, but these are vehicles that most Americans are using to save for retirement and future healthcare expenses. So we want to make sure that you're taking full advantage of those benefits. So that kind of rounds out some of the bigger tax-related benefits for retirement and healthcare savers. So please take advantage of that. You're doing yourself a favor by saving for your future. I personally feel that it's as good of a time as ever to take some inventory when we get to the start of a new year. And there's a lot of different things that we need to get our arms around, namely our estate planning documents. Maybe we have a will, maybe we have a healthcare power of attorney, maybe we have a revocable trust, maybe we have a testamentary trust. Are they still reflective of your current intentions? So that's first and foremost. If you do not have any of those documents, then it's a good idea to consult with us as well as an estate planning professional as to the relevancy of those documents. But we find more often than not that people put their intentions onto paper and they don't make changes as their situation evolves. So get a good handle on that, but take it a step further. Look at all of the various different assets that you have. Who is the beneficiary on those assets? How are the accounts titled? Are they titled just in your name? Have you recently become married? Have you gone through a divorce? It's very important to look at the different financial instruments that you have, specifically insurance and investment accounts, and make sure that the beneficiary arrangement that you have on file is correct. I always think it's a good idea to give you a couple of different case studies and to talk about situations that we've dealt with over the last year to explain to you why it's that important that you start to think about your current situation. First situation, had a husband and wife, and they were married after the wife had already purchased the family residence. And I had said to the client, how is your house titled? And she went on to say, well, it's just in my name. But if something happens to me, it'll go right to my husband. I said, well, that very well may be the case, but there's the possibility that you may have to go through probate because there's no spousal continuation when a spouse is not named on the title of the house. So a conversation ensued. The client went and sat with an attorney, and they very simply retitled the house. A second example, for those of you that have adult children, but not adult children that are fully on their own and independent. The worst phone call you could possibly ever get is your son or daughter over the age of 18 has been in an accident and is in some sort of a institution, a facility, a hospital. And you are trying to inquire to get as much information about that situation as possible. If there is not something that is in writing that allows you access to what is considered an adult over the age of 18, you may have a very hard time better understanding exactly what's going on. Now, this is most certainly a worst case scenario and a situation that not any of us ever want to be a party to, but if you don't have the necessary documents in place, it very much so can prevent you from getting access to that information that's very important. So the takeaway here is you may think that you've done all of the best planning and the most beneficial planning that you possibly could do for your family. But it's good for you to have those conversations with your professional advisors and get them together as a group and as a team to confirm that everything it is that you do have in place is accurate based on your situation, and that it's going to allow you to do the things you want to do and have your assets pass the way that you want them to pass. So in closing, 2019 has been a great year. We hope it's been a great year for you. We hope it's been a great year for your families. We hope you've had nothing but all of the success in your business, your working life, and your family life. But let us be a party of that. Let us help you with making sure that the planning you're doing now is going to put you in a position long term. There was a great quote that the great Warren Buffett came up with. I can't remember the exact timing of it, but he said, an idiot with a plan will always do far better than a genius without a plan. And I feel strongly about that getting someone to put together a financial plan for you that incorporates all aspects of your financial life, that gives you something to serve as a roadmap for the future years that come, and holds you and another financial professional accountable will put you in a really good place to achieve all your goals. So we wish you nothing but the best this holiday season. Look forward to seeing you in the new year. This has been Matt on Money, concluding 2019. Make it a great year.